Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on corporate filings and try to figure out if these companies are just spinning their wheels or actually making big moves. Today we've got California Resources Corporation, or CRC, as they're known, and their latest report is a bit of a mix of strategic maneuvers and the ongoing saga of their merger. Stick around as we decode what this really means for you. Now, before we dive deep, if you love getting the real story behind corporate news without all the fluff, make sure you're subscribed. And hey, we've got a fantastic community over on Discord where we break down these filings even further. You'll find the link in the description below, so hop on over and join the conversation. Alright, so what we're re-looking at here is what is called a Form 8K. Think of it as a way for companies to announce big, important, and often immediate news that the public needs to know about, especially if it affects their business in a big way. This particular filing is dated the 22nd of September 2025, and it's all about some recent changes CRC has made, particularly in relation to a big deal they re-cooking up. The main news here revolves around California Resources Corporation, often just called CRC. They're an oil and gas company, and like many in that industry, they're always dealing with a lot of moving parts, from market prices to big corporate deals. This filing also reminds us that their common stock is traded on the New York Stock Exchange under the ticker symbol CRC. So if you own CRC stock or are thinking about it, this is the kind of document you'll want to understand. Okay, so the first big piece of information is about a material definitive agreement. In simpler terms, they've signed a really important contract. Specifically, on the 22nd of September 2025, CRC entered into an amendment to their credit agreement. Now, what is a credit agreement? It's basically a loan agreement. Companies borrow money to fund their operations or big projects, and this agreement lays out all the terms of that loan. This particular amendment, the sixth one they've made to this credit agreement, is quite significant. Its main goal is to help CRC, with a major pending deal, a merger with another company called Berry Corporation, or BRY. Why is this important? Well, when companies merge, especially with large amounts of debt involved, their existing loan agreements often need to be updated to reflect the new structure and ownership. This amendment likely smooths out some of the financial hurdles or requirements needed to get that Berry merger completed. It is like getting the bank's permission and making sure the loan works for the new, bigger company that will eventually emerge. Next up, we have a section about the company's results and financial health. Often, companies will tie in details from other parts of the report here, especially if they're sharing specific financial updates. In this case, they're telling us that any information mentioned later about their financial performance or condition in this report is also relevant to this section. It is a bit of a cross-reference to make sure all the financial info is clearly marked. This section is for other events, which means anything else important that doesn't fit into the more specific categories. And here, CRC announced something new on the 24th of September 2025. Just a couple of days after that credit agreement amendment. This is a major financial move. CRC announced they are planning to borrow a substantial amount of money, $400 million, by selling what are called senior unsecured notes. Let S break that down. Notes are just a way companies borrow money long term. Kind of like an IOU when they say senior. It means that if the company runs into trouble, these specific note holders get paid back before many other debt holders. And unsecured means there is tier specific asset tied to this loan as collateral. It is based on the company S overall creditworthiness. They plan to pay this back by the year 2034. Now, this part is important for any investor. They're flagging that much of what they're talking about, especially future plans like this note offering, the merger, and how they expect to perform are forward-looking statements. This is standard legal language. It means these are predictions or expectations about the future. They're saying these statements are based on their current beliefs and assumptions, but the actual results could be very different, and they aren't promising anything will happen exactly as they say. They also clearly state they do not intend to publicly update these statements if things change, so it is on us to keep track. And here is where they really emphasize caution. They're retelling us that their future predictions are subject to all sorts of risks and uncertainties, many of which they can't control. This is common in oil and gas. Think about fluctuating oil prices, regulations, or even geopolitical events. They specifically point us to their 10K and 10Q reports for more details on these risks. Generally, if a company highlights risks this strongly, it's wise to pay attention to those risk factors. As we mentioned, the Berry merger is a big deal. To move forward with it, CRC has to file a bunch of paperwork with the SEC. This includes a registration statement, which is like a formal declaration about securities being offered, and it will also contain a proxy statement for Berry shareholders that also functions as a prospectus. A prospectus is a document that gives potential investors all the details about an investment, its risks, and its potential rewards. So, this merger is progressing through the necessary regulatory and disclosure steps. They then provide a lot of information on where you can find more details about this merger, like on the SEC's website or their own investor relations pages. This is standard procedure for disclosure. This next part is about who might be influencing the vote on this merger. It details that the directors and executives of both CRC and Berry could be considered participants in the decision-making process. This is also standard legal disclosure, ensuring transparency about who has a stake in the outcome and how their interests might align. They refer to other filings and their own websites to detail who these individuals are and their holdings. This final statement in this section is a legal disclaimer. They're making it clear that this communication isn't an offer to sell or buy any securities. It's just providing information. They're also stating that any sale of securities related to the merger will only happen if it complies with the relevant securities laws, usually through a formal prospectus. Finally, we get to the exhibits. This is where they attach the actual documents that are referenced in the report. Here is the actual Sixth Amendment to their credit agreement that we talked about earlier. This is the formal document that details the changes to their loan terms. This is the critical press release about that $400 million note offering. And these are excerpts from the document that would be shared with potential investors interested in buying those notes. And at the very end, we have the signature block. This shows who signed off on the report, certifying that the information is accurate to the best of their knowledge. In this case, it's signed by Michael L. Preston, who holds some pretty high level titles: Executive, Vice President, Chief Strategy Officer, and General Counsel. Having your General Counsel sign off on a filing like this means it's gone through some serious internal review. So let's talk about what this all means for CRC on one hand. They are actively managing their debt and operations by amending their credit agreement. This is a sign of responsible financial management, especially with a big merger on the horizon. The fact that they can amend their credit agreement suggests their lenders are comfortable enough with their current standing and future plans to allow these changes. On the other hand, the announcement of a $400 million note offering indicates they are looking to raise significant capital. The question is, what is this money for specifically? While they mention it is in connection with the Berry merger, the exact use of proceeds isn't detailed here, which is something investors would want to know. Is it to finance the merger itself, refinance existing debt, or fund new projects? The timing of this offering so close to the merger announcement suggests it is directly related to solidifying the financial aspects of that deal. The Berry merger itself is a major strategic move. Mergers are inherently risky. They can create significant synergies and cost savings, leading to a stronger, more competitive company. However, they can also fail to integrate smoothly, lead to culture clashes, or prove to be more expensive than anticipated. The fact that they are amending credit agreements and raising new debt shows they are committed to making this merger happen, but it also increases their financial leverage. If oil prices drop, or if the combined company does perform as expected, this increased debt could become a burden. Looking at CRC's strategy, it seems they are focused on growth through acquisition, as evidenced by the Berry merger. This is a common strategy in the oil and gas sector, where economies of scale can be very important. The key for them will be successful integration of Berry and effectively managing the increased debt load. They are essentially betting on the future value of the combined entity and their ability to navigate the volatile energy market. A notable risk here is the debt. While senior unsecured notes are common, $400 million is a substantial amount. Investors need to be confident in CRC's ability to generate enough cash flow to service this debt, especially considering the inherent fluctuations in the energy sector. If oil prices were to plummet, or if there are unexpected operational issues, repaying this debt could become a serious challenge. In conclusion, California Resources Corporation is in a period of significant strategic activity. They are clearly pushing forward with the Berry merger, which could lead to a stronger, larger company. However, this ambition comes with increased financial commitments through debt financing. The success of these moves hinges on their ability to integrate very smoothly, manage their expanded debt obligations, and navigate the unpredictable energy markets. They're replaying a big game here, and the outcome will depend on smart execution and a bit of good fortune in the market. What's your take on CRC's latest moves? Are you excited about the Berry merger or concerned about the new debt? Let us know your thoughts in the comments below. If you found this breakdown useful, please give this video a thumbs up and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community, the link is in the description. Thanks for watching, and we'll see you in the next one.